all time, my Aussie, crazy Aussie, John Seville. John's going to be here with us for the next hour, and let's bring him up. Now, this topic is, I mean, I've heard him give it, but lately hearing him give it is like hearing it way different because of what's going on in the market. And he's pretty damn active when it comes to what's going on, but he's also, you know, the big thing with Johnny is he's set it and forget it. And when, you know, I'll be talking to him about the market, and he'll be like, well, I went surfing and I jumped off Pablo Escobar's tunnel and got in a hang glider and flew across South America, whatever. It's always some crazy story, right? Koalas in the trees. But it's proof, like you're living proof, Johnny, that you can trade, make money, and then go have a real life, and even run your own business in a minimal amount of time where you can have this amazing life that you've built around your ability to make money in the market. And so I'm going to unshare my screen and let you share yours. And where are you right now, John? You're still in Australia?
Yep, I'm in Australia still. We were meant to leave 6 weeks ago, but the airports are closed, so here we are.
Hunkered down.
There are worse places to be.
That is damn straight. Prison or the hospital. That's what I'm going with.
Yeah, well, we won't get into that. I hear the cruise lines are starting to go again in August. They're booked up.
Hey, look, you've got a little bit of a scratch when you're talking, so maybe pull the mic off your mouth a little bit.
Okay.
All right, now talk for a minute.
Testing, 1, 2, 3.
Sounds good. All right, can everybody hear him okay?
Yeah, sounds great, John. Yep.
All right. We'll be right here, buddy, if you need us. It's all yours.
Awesome. Well, thank you for that great introduction, Jeanette. You've it's early morning here in Australia, but certainly puts a smile on my face. And look, that to me is what trading is all about. Some of my inspirations. I remember when I was about 19 years old, and I was walking down the Pat Bay Highway in Victoria, British Columbia, reading the 4-Hour Work Week with my book like this, with trucks zipping by me because I just couldn't put it down, and another book, The E-Myth by Michael Gerber, and all great books which all talk about the idea of being efficient and doing the minimum effective dose, which was one of the 4-Hour Work Week's messages, and other business partners I work with talking about the fact that if you do something more than once in a day, automate it, and so whether it's in business or in the stock market or in life itself, I'm always looking for life hacks, ways to make things more efficient and to systemize things. Put the work into designing the system, and then once you have the system, automate it. That's the idea of getting your life back and having money work for you. And so as Jeanette said, look, that's what I'm all about, is working smart, not hard. So anyway, with that being said, we'll begin today's presentation. And nice to see a lot of familiar faces in here. So g'day, everybody. Today's workshop is all about smart money trading and about systems. So we'll start about the disclaimer. The course is for educational purposes only, not a recommendation to buy or sell any of the securities discussed. For full disclosure purposes, I am holding many of the positions that we will be talking about, but of course stock trading and option trading does involve risking all the capital that you invest. Okay, so let's start out with, this is a very exciting day to be talking about the market, especially smart money systems. And we'll be bringing up some live charts of the S&P 500 as it closed today, some key things to see here. But to start out with, look at this image. Now, this really kind of puts into perspective where we're at, the craziness of where we're at. Just a few weeks ago, Kramer had this image on TV of the best week since 1938 in the background. And then in the foreground, 16 million Americans lose their jobs. There's a huge disconnect with what's going on in the news and what you're hearing versus what you're seeing in the stock market. And so for me, a big part of today's presentation is how we cut through all the proverbial you-know-what. Right, and get down to what's the truth, what's really going on, and cut through all the the you know what. So that's what today's agenda is all about. How do we find the truth? And that's really what the webinar could be called, the search for the truth. We're going to look at the current market conditions. We're going to look at ways we find this truth by looking at the smart money and what those big investors are doing, and then drill down into patterns and probabilities, as well as seeing where the insiders of the companies that we're looking at are going and investing with their own money. And that's really a game changer, because if you want to find the truth of anything, as we should know, follow the money. And that's something we can do here. A little bit about Acorn, for those of you that may be newer to us. I see again a lot of familiar faces, but we've been around for a while. Last year we did 464 winning trades. In 2019, we had an average return of 122%, which included included the losses. That's mostly stock. So if you are an options trader and you're trading spreads or calls and puts, obviously the potential is higher. But as Jeanette said, the focus of all of what we do is set and forget. So if you are someone that traditionally is working a 40-hour work week or a 60-hour work week or what have you, this is something that can work very well for you. Or if you're somebody that does a bit of day trading but doesn't want to be forced to day trade in order to make money, or you want to go away on holiday or things like that, again, this is a very applicable strategy for you. And those are some of the key reasons people come to us, for the smart money, for the set and forget strategies, and our insight into patterns, which is a big focus of what we'll do today. We've been doing this since 2007. Some of our claims to fame have been the crashes we've seen since then. We called the crash of 08 months before. I think it was February of 2008. We exited all of our long positions, and every crash since. And it's not because we have a crystal ball. It's because we have a very unique way of tracking where the really big money is going. And surprise, surprise, in all of these major downturns, they've been getting out before retail investors knew anything was wrong. It's not a surprise to me. It shouldn't be a surprise to you, because the system is rigged, plain and simple. So that's how where we need to get into is to how we detect that and jump ship before we are the ones left holding the bag. And do this using a system, because as Buffett says, if you don't find a way to make money while you sleep, then you will work until you die. So if we're still exchanging time for money by having to be in front of the screen to trade, having to watch every tick of the market and be constantly on this verge of anxiety every swing the market makes, it's not a way to live. Even if you make more money by doing it, I would easily give away 20% of my profits in order to have 95% of my time back. And again, that's a big focus of what we do. Before we start into the technicals, though, I'll tell you a little bit about myself, because a lot of people would have you believe that trading is just easy. Just push a button, off you go, $20 bills, spit out your CD-ROM. But as we know, it's not that easy, and it wasn't that easy for me. I started in 2003 working as a customer service person in a stock market software company, and my main job was to work with traders, help them use the software, and basically my insight here was I got to watch some of the biggest and best traders in Australia at that time and what they were doing, and here I got to see how much money could be made if you did it right. I also saw how much money could be lost doing it wrong. But for me, I was hooked. I started trading. I borrowed 10 grand. I was about 17 years old at the time. Borrowed 10 grand from my dad, and off I went. And success, right? First 3 months, I was up to $60,000. And at 17 years old, I thought, why would I do anything else? This is too good to be true. I've just made $60,000 in a few months. As a 17-year-old, I found my calling. And of course, the problem with that was that maybe I was lucky, maybe I had a good gut instinct, maybe some of the things that these other traders had taught me had rubbed off. But once I started to get into that excitement zone and the greed zone, the whatever rules I had disappeared very quickly. And now I was thinking, gee, I can turn 60 into 300, then 300 into 1 million, then 1 million into 3 million. I'm a millionaire. And that's the way my head was thinking, getting way ahead of itself. And so what inevitably happened is I lost it all in a week. And then I did it 2 more times. I blew up 3 accounts in total in the first couple of years of me trading. I was about $100,000 in debt, without an income, and that was pretty scary. So I went back and thought, well, what am I doing wrong? Why are all these other people making money and I just seem to lose no matter what I do? It's just, I have the death touch. And so I thought, okay, well, I need more stuff. So I need more indicators. I need more news. I need more subscriptions. I need more everything. Let me just go out there and accumulate. And I bought all this stuff and programs and everything. Still didn't make money. And this is perhaps where some of you are at now, or maybe a journey you've been through, but everyone goes through this. It is normal. And it's humiliating, especially when you're talking to your partners, your family, your friends about this thing you're excited to be doing, which is trading. And then you have all these losses. It brings you back down to earth, and you don't want to talk about it so much when you're in that losing streak. But one of the things that one of my mentors shared with me is he said, Johnny, look at all of your trades. You are so focused on news. You're reacting. You're doing all of the stuff that retail traders are doing. So where's your edge? What are you looking at that no one else is? And I thought, that's a good point. And I looked at all my trades and saw that they were very reactive. They were very emotionally charged. And remember, this is exactly where the system wants you to be. They want you to be following the headlines, listening to the dings and dongs on TV, and it doesn't work. So my dream of being this traveling trader, which I can say I've got to now, but early on, this always was my dream. But my dream had been replaced by the reality of just losing money, filling everyone else's pockets, with my cash, and I wasn't doing any better off. So that's, I guess, the first thing that we want to define here as we go out to look at the search for the truth, is to identify the problem that the system is not there to help us. Right? The banks want you ignorant because they want you to give your money to them. Brokers want you to be ignorant because they want you to give your money to them. And at the end of the day, most people want you to be reliant on someone else because that's how they charge you more money. Right? There is very few places out there that are there to empower you. And so that's the big issue, is that most places we go to look for help aren't there to help us. And that's the problem that I had, because I don't even want to think about how much money I spent on things that didn't work. I made a lot of people rich, I'm sure. And that's why eventually we started Acorn, because we wanted to be one of the first, and probably, and still one of the few educational companies out there that are very transparent, that are teaching you the same thing that we do every single day with our own money, and unlock some of these things behind the scenes. And for me, that was the game changer. And in 2017, I went from losing hundreds of thousands to having my best year ever. In 2017, that was probably my best year I've had on the record, where we made a $3.5 million profit, close to, or an 142% profit that year on stock only. And it was all coming back to the stuff that and the techniques I'm about to show you. And again, I don't share this with you because I want to say, look how much money we made that year. It's not for that. I want to share this with you because I want you to know that for the next hour or 45 minutes, that you're listening to somebody that does do this, that does trade, that is that practices what they preach, and this is how we do it. So let's start with the market. With the market, a lot of people are talking about the coronavirus, understandably so. But remember that we didn't get here because of the coronavirus. That wasn't the reason why this market needed to crash. The market needed to pull back because it was overbought. The S&P 500 was overvalued going into the end of last year before the coronavirus hit. Excuse me. So the price to earnings ratios were at levels we'd never been at before in the history of the stock market. The only time we'd been up there was the dot-com bubble, and that was different to now, because the dot-com bubble was just one sector that was overvalued, whereas recently we had almost every single sector well beyond their historical averages. And so that's a bubble, and bubbles pop. And when we start to look at the truth behind that, because there's all the news saying this, that, and the other, but what we need to do is we need to find out how to have any insight into that truth. What should we do about it? And to that, one way is we look at the insiders. So the guys that are running the companies that we're looking to invest in, the CEOs, the CFOs, the insiders, these are the only people that actually know what's going on with their companies. Everyone else is speculating, including me, including Warren Buffett. We're all speculating. Insiders know. So when insiders are selling at dramatic levels in the 3 months leading up to the crash, that was a big red flag. In the 30 days leading up to the crash, when they were selling $2.2 billion worth in the services sector alone, that was a huge red flag. And I don't need to know the reason why they're selling. Just like if I'm standing in a field, imagine this, you're standing in a field, you're looking out over the horizon, and you start to see hundreds of thousands of animals all running towards you in one direction. What would you do, right? Do you sit around and go, "Would you wonder what they're running away from? I'm going to figure that out." No, you would run with them. And in the same way we do in the stock market. I'm not here to be the smartest cookie in the room or the smartest person in the room. I'm here to make money. So if I see that all the money that matters is running in one direction, I don't need to know why. I'm going to go with them, and we'll find out later, as we did. And another big red flag that we saw coming was the IMF. The IMF talked about the issue that we had $19 trillion worth of debt in the market going into 2020. This is debt that was at risk of bankruptcy. The IMF said that if a major market downturn occurs, we've got $19 trillion. I think that's closer to 25 now, but $19 trillion that's at risk of default, bankruptcy. So that is equivalent to 40% of the total debt of 8 major economies. That's a big red flag there too. So that's the background that we went into 2020 with. And so when we first started warning people that we were going short and that we were protecting our longs, that was actually in December. Our we're getting out of everything warning came in January. And then we found out the reason and the catalyst really came in February, being the coronavirus. But we're still not out of it. So let's now delve deeper into the smart money signals to take a look at how we then turn these ideas into executable trades. That's the next part, right? As we piece things together. So, indicator 1 of the 3. Indicator 1 is looking at the idea of what the stock market really is doing. Okay. So one thing that you might want to write down, it's a lesson that stuck with me for decades, for the last 20 years, is that there is no such thing as the stock market. It is a market of individual stocks. All right. So what does that mean? Well, let's look at the S&P 500 here. We're looking at April, May, June, July over here on the left-hand side of the screen. Where's my mouse? A few screens here. Here we go. There we go. April, May, June, July. Notice that the market goes sideways all the way through to August. Now, what then happens after that is it has this flash crash. It then recovers completely up into December, and then on December 29th, we flash crash again. Now, these are the kinds of moves that we as investors or traders need to anticipate, right? So was this predictable or not? Let's have a look. So what we're looking at now is a different way to look at the market, a far more powerful way, in my opinion. This indicator represents what percentage of stocks in the entire market are above or below their smart money support, which is their 50-day moving average. 50-day moving average is very important because it represents institutional buying, mutual funds, your larger institutional types of buying and selling. So you want to see stocks above that level if they continue to have that type of support. And they did in April. In April, there was 70% of stocks above that 50-day moving average. But watch what happened next. As the market went sideways, individual stocks began to decline. And so we went from 70% all the way down to 30% by the time the S&P 500 began its decline. So when did the market start crashing? It wasn't August. It was April. The S&P 500 then recovered. Stocks did too, and we got up once again to this threshold of 70%. And you'll see this number come up again and again and again. The 70% number is very important. Again, 70%, we hit that in October, November. Market didn't crash till December 29th, but what did individual stocks do? We were again down to 26% around December 10th, weeks before the market responded. Okay, so looking at this indicator alone was something that gave us in the first case, months of warning, and in the second case, several weeks of warning of what the market was about to do next. Very powerful. Is this making sense, by the way, everyone, so far? Give me a quick thumbs up, a quick yes in the chat box. Not getting too technical? I think Micah and I share that. We both like to talk fast and we both like to overeducate. All right. So 2018, let's look at that. 2018, we had the same thing happen. We had these two very fast, very reactive market moves. But let's delve deeper, right? Take a look back in January. What's the market doing? The S&P 500 is rallying up in peak excitement, right? It's going straight up. Everyone's getting excited. Everyone's having FOMO. You know, gosh, I better put my money in. This thing's going to the sky, to the moon, as you hear people say, right? And then after that extremely bullish candle, straight down, catching a lot of people unawares. So that happened in February, beginning of February. Then we reached record highs again in October, breaking through that double top where we crashed before, making people think, oh, we've overcome a huge level of resistance. We should be going long at the worst time, right before a much worse crash. So let's delve deeper. What happened with the smart money signals? Well, where's my, let me just have a look here. Where's my drawing tool? If we take a look at where we got up to, look at that 70% number again, right? In January, early January, we hit this same 70% threshold. 3 weeks later, it started turning down and the market followed, okay? Look at the crash of October. When did we hit 70%? We actually hit 70% in June, right? In June, we hit 70%, and by the time the S&P began crashing, we were once again already down to 30%. This indicator has been a very, very reliable way of giving us a signal as to when we should start getting short. That signal is whenever we hit 70% or above. Whenever we hit 70% or above. In fact, historically, 80% of the time, roughly, when we hit 70%, individual stocks begin crashing the very next week. So that's pretty important. When you've got that kind of a track record, you're going to listen. So what happened in 2020? Well, here you go, right? December, we hit 70% on December 16th. We then tagged it again and hit it again in early January, and that was our warning. That was when we said to our students, this is now time to get out. This is now time to protect our profits with stop losses. This is now time to start looking for the very best shorts. And that's what we did. It's what we alerted to our students. It's what we did ourselves. So, and then we found out later why. All right. So that's indicator one, or system one. System two. System two is when we then start tracking smart money in another form. And the second form that we're going to track smart money in is through the bond market. Now, keep in mind and remember that the bond market is significantly bigger than the stock market. It eats it up, right? Bond market is massive. It's huge. So when you're looking at the bond market, this is a very good way to get insight as to what the big boys and girls are doing in terms of their money. The way we're going to track the bond market's appetite for risk is by looking at something called high yield bonds or junk bonds. The symbol is HYG. So firstly, let's look at the market. Remember 2015, we went sideways until August, then crashed. rallied up to the same highs, crashed again. So what was smart money doing? Were they following what the S&P was doing, or were they doing something different? Well, we already know that they were doing something different because they were selling off individual stocks long before both of these events. But let's look deeper in a different way at the bonds. What were high yield bonds doing? So high yield bonds should move with the market. The S&P should go up, and if the S&P is really going up versus a false move, high yield bonds should be following it. What you see here is the opposite. The S&P was going up, but bonds were going down, right? So as the market went sideways, high yield bonds were selling off, saying, we need to get out of this, trouble's coming. The S&P 500 then recovered all of its losses. But what did high yield bonds do? They continued to sell off. They said, this isn't over. Continue to sell, keep getting out, pulling their money out of corporate bonds. So that's not what you want to see in a healthy market, but that's exactly what you want to see if you're looking to short the market. That tells you that there's a divergence between what you think the market's doing and what the real market's doing. Another fantastic smart money signal, right? And then if we look at the second crash in October, oops, sorry. That was 2015, sorry. Yeah. So we continue to sell off there. Now let's go to October. All right. Remember the two crashes were there in February and there in October. Let's examine high yield bonds in both those instances. All right. Here we go. Here's February. So as the S&P went higher and higher and higher, what did high yield bonds do? They were going lower, and more importantly, what pattern were they making? Everybody? What pattern do we have on the chart as we went into the end of January? That's right, a head and shoulders. Exactly. The head and shoulders is a pattern that is one of the highest probability predictors of a market top or at anything top. It doesn't matter whether it's Amazon or the US dollar or the S&P or high yield bonds. It is the number one highest probability predictor of a topping chart. And if we measure that head and shoulders, it predicted that we were going to drop to 84.20. And if you have a look at where we went to, that is exactly where it dropped to. Okay. And there's a question, don't bonds have an inverse relation with stocks? It depends on what bonds you're talking about. High yield bonds do not have an inverse relation to the market, because high yield bonds are bonds that the big money buys if they want to say, hey, corporate America's A-okay. The companies like Netflix, all the companies in the market that are borrowing junk debt, they borrow that from high yield bonds. They want to raise money, they raise it from high yield bonds. These are the riskier companies, right? And so if the bond market says riskier companies are the way to go right now, let's lend money to them. They do that by buying high yield bonds. So if there is a demand for lending money to corporate America, especially the high risk group, bonds go up. If they're saying, no way, corporate America's in trouble, I don't think they're going to be able to repay their debts, they're going to take money out of bonds and bonds go down. So the high yield bonds should follow the index. When they don't, this gives us our insight to what's really going on behind the scenes by those that actually know. I hope that answers your question. High yield bonds and junk bonds are the same. So again, in 2018, second crash, same thing, all right? Bearish, head and shoulders as that second top built. Okay, so when we go into 2020, let's have a look at what we see here. What pattern do we have in high yield bonds as we peaked in 2020? What pattern? That's exactly right, an upward channel. An upward channel is a bearish pattern. A lot of people have been incorrectly educated, and that's the problem with going through YouTube channels and things like that, where you're trying to piece all this together yourself. Upward channels are not bullish. Upward channels are bearish, because what an upward channel tells you, and the point of any pattern is not to tell you what's happened before, but what's going to happen next, right? We know what's happened before. Tell me what's about to happen. That's the point of a pattern. And an upward channel tells you what's about to happen next is a breakdown. So an upward channel is bearish, and typically after 3 touches on support, that thing's going to crash. So when we saw that high yield bonds were in an upward channel, we shorted it. This was another reason on top of the first indicator that high yield bonds were telling us the market was due to correct. All right, and so we shorted it. And again, I mean, this is, as I said at the beginning of today's presentation, this isn't hypothetical. Everything I'm showing you is what we do ourselves with our own money, and it's also what we alert our students. So when we saw that on high yield bonds, we bought puts on high yield bonds on February 21st. So here's how the alert appeared on our website, on our customer portal, right? If high yield bonds break below 88.71, we're going to buy $88 May puts, which were $1.23. And because it's set and forget, we pre-program our first target to take profit as soon as high yield bonds drop to 84.53. The second target was momentum. In other words, let it continue to drop until it eventually stops out. We predetermined our stop loss. Okay. So this was the trade we suggested to our students, and that's the trade we took, as you can see. So when this is a screenshot from our interactive brokers account. So as you can see down the bottom, as soon as high yield bonds hit the first target, we bought a bunch of puts at $1.23. They were now at $3.60, and this allows us then to do the most important thing, which is protect our capital. Right? As soon as we hit that first target, even though we think it's going much lower, once we've already tripled our money, why not take our original capital out? We can also take out a chunk of profit as well. Now we're trading with the house's money. Now we're playing with the house's money. We can let this thing drop as far as it wants, but the anxiety now behind the trade of what we have at risk is gone. Well, at least for me it would be, because now I know I've got my original capital back. That's in my pocket. I've locked in a profit as well, and now what I've got left riding in those options is pure profit. And those puts ended up dropping. HYG continued to drop sharply, and those puts ended up getting up to $15, so close to a 1,300% return in the end. But that's just one trade. So as you can see, we were able to take out 18 grand worth of profit just at that first target, and the rest is just the cream on top. So that's indicator 2. And what we're doing here is we're building a structure. We're building a foundation that we can make educated, informed, insightful decisions from. So the third piece to the puzzle is then we look at this indicator which we developed about 7 years ago. This is probably one of the most valuable parts to the entire process, because it tells us a directional indicator which is very time-based on the S&P 500. Now, this indicator, we developed this, again, as I said, 7 years ago, and the track record of this is incredible. If you go back 60 years, 60, there's close to 1,400 alerts on the S&P from this system. And the success rate of that is just under 93% successful. So there is nothing more, there's nothing we do with a higher track record than this. And I don't use it to trade futures. If you were a futures trader, this would be extremely valuable. I don't like trading the S&P either. The way I use this personally is to tell me whether I should be looking for shorts or longs. So I use this as a top-down indicator analysis to say, where's the S&P going? then I go and search for the best trades in that direction. So remember, right now, when we went into 2020, the stocks were above 70%. So indicator 1 told us to short. High yield bonds were in an upward channel. So indicator 2 told us to short. And then when we went and looked at this system, it was telling us at the end of February to short as well. All three now are telling us which direction to go. And in every major correction that we've had in the last 12 years, it's the same situation. All three indicators lined up. So, and if we have a look at what that's doing now, let's just go to the SPY here. Go back over the last 9 months, so you can zoom in here. All right, if I just get rid of that Fibonacci line for a second, can everybody see the indication here? Right. There was our big red. There's our big red signal at the top of the market, and it also told us to go long at the bottom. That was a really key thing too, by the way. I don't know how many students we have in the room, but that was very difficult for me to. This is the difference between emotion and rules. After that incredible crash, very profitable if you were on the right side of it. We then got the indication by all three of our indicators to go long in April, and trust me, it was very difficult for me to then go out to all of our students and say, the drop is over. This is now the time to load up and go long. It felt really, really hard to say that because I couldn't conceptualize how the market could possibly go up given what was going on. But the rules told us to. And that's the difference between rules and emotional trading. And so not only by following the rules were we able to lock in all of our profits from the shorts, but we were then able to take advantage of, as Kramer said, the best rally since 1938. Best drop and best rally. And now what we're seeing is the turn back down. Both these last two signals are bearish. So we are preparing again for what could be a very nasty drop. There are a whole bunch of other reasons for that, and I'll show you those now. But does everyone see the system so far? Does everyone understand that? 1, 2, 3, right? These three systems can be looked at in a matter of a couple of minutes each day, or every few days, really, because we're not looking at changes day to day. These are signals that hold strong for 2 to 3 weeks at least. So it's really more of a weekly thing. And now that we've got our bearish signal, this is likely then to continue all the way through till the 3rd week of May. But let's go one step further. Now let's look at the charts. Okay, I'm going to go over to TradingView to take a look at the charts. Okay, so firstly, what pattern, guys, do we see on the S&P 500 since the beginning of March or the middle of March? What pattern do you see here between those blue lines? Isn't that an upward channel, right? That's an upward channel. Upward channels are bearish. Okay, let's zoom in even further. Let's go to the hourly chart to dig deeper. But if you can't see the upward channel, it's yeah, you can see it here, right? There's the bottom of the channel. There's the top of the channel. Let's go to the hourly time frame. We can zoom in further. Okay. Now, if we go to the hourly time frame, now you can probably see the upward channel more clearly. So we're coming to the end of that. Now there we go. Now let's zoom into the right-hand side of the chart. What pattern do you see here on the hourly chart? A head and shoulders, the #1 highest probability pattern that exists for the top of a market. So we've got an upward channel and a head and shoulders. And hey, let's just zoom in over here on the right-hand side to just the last couple of days. What do you see inside the head and shoulders? What do you see here? Another head and shoulders, right? So you've got an upward channel, a bigger Head and Shoulders and a smaller Head and Shoulders, all inside each other, one on top of the other. As we go into the jobs report later this week, this is so this is all lining up. Every pattern you see here is all pointing to the bearish direction. So notice that in all of this analysis, at no point do I need to listen to what the news is saying. In fact, it's better that you turn it off. I haven't listened to the news, financial media for years, because it just takes money from me, right? Especially when you've got especially when they're statistically wrong, and especially when you have other systems like this that are statistically very right. High yield bonds, this indicator, the patterns. I mean, these are data-driven systems that tell you the truth with probabilities and rules. Much easier, because in a few minutes I can get a very high probability answer to the most important question, which is, what should I do with my money today? And the way we then go one step further in this is, and second, just get my cursor back. All right. The way we go one step further than this now is we start to say, right, now we know the market direction, let's find the best trades. So I'll go out then and run my scan looking for the highest probability longs or the highest probability shorts. And what makes up that recipe of the perfect storm is going to be the combination of the pattern and what the smart money is doing, but now in the sense of a stock. Remember, all of this is set and forget, especially now that I'm in Australia on lockdown here and can't go anywhere. I mean, I'm asleep when the market's open. I go to bed at 9 o'clock at night. The market opens at midnight, right? I wake up at 6 o'clock in the morning. Market's already closed. So especially for me at the moment, I'm not even able to be awake when the market's open. So set and forget is very important. These systems become very valuable. And actually, Jeanette mentioned Colombia. That was a photo of me in Colombia when we didn't even have internet for 2 months. The place we were living in Colombia had no internet in this tiny little country town. So we actually had to hike up into the mountains, to the top of this mountain, so we could get 4G internet on the cell phone and hotspot off the laptop and sit there for an hour on this one rock that was conveniently looked a bit like a desk, and trade from there once a day, right? Set and forget is incredibly powerful. So volatile markets don't mean you need to sit in front of the screen all day. It just means you need to have rules. So when we apply these rules to the trades, what are we looking for? Well, number one, the pattern to begin with. Remember, 95% of the volume in the market is estimated now to come from algorithms, right? JP Morgan did this report months ago. They said close to 95% of the volume each day comes from algorithms, right? So you need to know how they're making decisions. You need to know where 95% of the volume is going, and they make decisions based on patterns. So these rules are so important. And this is one of the shorts I wanted to share with you, Crocs, right? When we searched for high probability plays back in January, because the indicators told us to, Crocs came up. So what was the pattern? Well, we had 2 upward channels inside each other. So technically speaking, we now know that probability is on our side. Close to 90% of the volume is if they're following the rules, as indicators algorithms do, they're going to push this stock down, right? So the first check, do we have a very bearish pattern? Yes. Second test, what about beyond the technicals? What about the story behind the trade? Okay. Why is this an extra special trade that could really drop a lot? What makes it special? Well, for that, we need to go beyond the pattern. We need to look at the fundamentals. Is the company perhaps in trouble financially? Is the business model failing? Is the industry weak? Whatever these reasons may be that add the extra flavor behind the scenes. Now, I'm not an expert in Crocs. I'm not a fundamentalist. I'm not an economist, nor would I want to be any of those things. I didn't work in Wall Street, nor would I ever want to. So how am I going to get the insight behind Crocs when I'm not a specialist in this industry? Well, Who is? The insiders. Remember, no one on television, not Buffett, not JP Morgan, not Goldman Sachs, not me, no one knows what's going on with the company other than the insiders. No one. So why would I listen to anyone else's opinion when I can see the very best research right there on the screen from the only people that actually know? Let them do the work for you. Why does it matter what Joe Bloggs down the street thinks if they think it's a great buy, if you've got the 10% owner selling $243 million worth or 100% of their position? There's not a not a chance in hell I'm going to put a single red cent into that stock if I see the insiders selling. Would you? Right? No, instead we're going to short it. So we said, okay, let's short Crocs. Let's buy June $40 puts at $4.70. Let's set and forget if it breaks down below 38.47 to trigger that trade. Let's pre-program to take some profit at 31.13. Let's pre-program to take some profit at 28.13. We've got our stop loss that we're going to check on every few days and lower as the trade progresses to lock in the other profit that we've already made. And as I said, this is all real stuff. None of this is hypothetical. None of this is hindsight. This is all stuff we did and alerted to our students. And there it is, right in our portfolio. All right. We bought the first round of puts at $4, and we sold the first chunk at 11 for a $3,000 profit. So that allowed us to take our original capital out, lock in some profit, and let the rest ride. And that ended up going all the way to $16. LPSN, same thing, upward channel, right? Same. So do we have 90% of the volume going in our favor? Yes. Right. Understanding the pattern is so important because it's so simple, right? You can fill your screen with hundreds of indicators, but really the only thing that matters to me is where are the algorithms going? They don't look at MACD. They don't look at Bollinger Bands. They don't look at Keltner channels. But what they look at is price action. So what matters to me more than everything is where's 90% of the volume going? So do I have a bearish pattern? Yes. Next, let's look behind the scenes. What's going on fundamentally? Is there anything that we could see from the insiders? Well, there we go. We've got insiders dumping as much as 83% of their position going into at the peak of their stock's rally while the bearish pattern occurs. 1-2 punch. Right? What else are we not, because what else do we not need to look at here? Remember, we've now got the technicals on our side, which give us a very high probability signal. And on top of that, we're accounting for information we couldn't possibly know from a fundamental standpoint, industry standpoint. I mean, these guys know better than we could ever hope to about their industry and specifically their stock. So there you go, another trade. Those puts went from $4 to $16 as well. So even if you had $1,000 in that, you're looking at close to a $4,000 profit on that trade. If you had $10,000 in it, $40,000 profit, and so forth. Again, we were in that trade too. We practice what we preach, as one should. Right? And again, let me remind you, this is not day trading. This is all swing trading. This is all set and forget. You can do this from anywhere. And it also works for the longs. Because this is not just about shorts. Now, it's going to be probably for the next few weeks, because if this market continues to do what it's currently doing, which all of the indications currently suggest, we don't just want to be short anything. We want to be short the companies that are going to really plummet, the ones that are going to really lock down. Okay? Those are the ones we want. And we want the stocks that are so weak technically and fundamentally that even if the market goes up, they're still likely to go down. We want that insurance that they're so good as a short opportunity that we're confident they'll drop anyway. And then on the long side, we want to look for the stocks that are so strong that even if the market is weak, these stocks still have a good probability of going up. That's why this perfect storm of this value and the two things that we're looking at here need to be happening. Both of those need to be happening. So KRTX is an example of a long that we would look for, right? This is one we alerted last year. Look at the insiders, right? They bought 68% for $11.2 million. 14% for $3.2 million. Then you've got another insider who'd never bought before. First time ever buying their own stock. And it's all happening at the same time, right? What happened next? Well, the insiders loaded up at $16, and a few weeks later, the stock went from $16 to $145, $150. That's the kind of long I want. The only kind of long I have any interest in is one where the insiders are buying like that, because we need that kind of security, that kind of confidence, that kind of power if we're going to put our money into it, right? MYOV, look at the insiders, all 10% owners buying $20 million each. 8 insiders that each own 10% of the company. That's 80%. 80% of the owners are all buying at the same time at 8:25. So what did we do? We alerted it to our students. It was a perfect pattern. Have a look. Right? We had a beautiful downward channel. Sorry, one second. We had this beautiful downward channel. Downward channels are bullish, much like upward channels are bearish. So do we have the pattern? Yes, we do. Do we have the insiders loading up? Absolutely, in a massive way. And so we alerted this as an option and a long, and this went from $6 to 20, just under $20 in just a couple of weeks. In fact, we alerted this 2 days before it took off, because that was when it was breaking through the channel, and it just happened to be days before the gap up. And when we got to the high, some insiders sold. It hit our stop loss around $17.40, and that was the end of that trade. But then it fell. Now, by the way, the reason this stock rallied was because they created the cure for lupus, or a treatment for lupus, first ever successful treatment. So when this thing fell all the way back to 650, what do you think we did? Well, the cure hadn't gone. We're getting the same stock at a bargain price with the same fundamental data that made it go to 20 bucks. But not only did we buy it back, but so did the insiders in millions and millions of dollars of new buying at around $6.50. The same price it started from, and now it's at $12.50. It's still a current alert of ours to our Acorn students, now up 100%. I mean, this is the kind of stuff, guys, that we're going to be interested in. Now, I'm getting short on time here. I think I'm the last speaker, but let me go back to my slides here. I mean, but this, I could show you stock after stock after stock. There's so many examples. ET, massive buying at $4.89, right? Oil company. So did we. We bought it at $4.40. The stock also pays a 27% dividend, which is being paid. They didn't cancel it. So just by holding the stock, I'm making 27% a year, and it's up 100%, right? These are the kinds of stocks I'm long now, because they have this power behind it, the patterns, the smart money. KALA, another example. I mean, again, there's so many. So let me fast forward here a little bit. I get taken away, but this is what we do. This, you can see in all of that we've talked about today. We've got a strategy behind the alerts. We're saying we know exactly what we're looking for and how to find it, right? If you don't know what you're looking for, if you don't know what would cause you to go long, if you don't know what would cause you to suddenly sell everything you have in the market, like we've done recently, then how are you going to know when you see it, right? You're constantly reacting emotionally, which in my own personal experience only leads to losses, versus focusing on a very simple but very sophisticated way of doing it differently, where we focus on where the insiders are going and where those powerful patterns are setting up. That's what we provide, right? That's what we provide. We provide the same strategies we use ourselves. We provide you the same indicators that I've talked to you about today, and teach you those. But what we really provide is no BS strategies that we use ourselves that allow you to focus, get back to the simple stuff. Trading doesn't need to be complicated. In fact, it's better and more profitable when you simplify it. So that gives you rules, it gives you strategy, it gives you confidence, it gives you a pathway forward, and allows you to trade smarter, not harder, like I said at the very beginning. And that's the difference between working for your money as a trader, which is just another job if you're trading time for money, versus being able to do this from anywhere, to set and forget. You know, whether you're on holiday or whether you're on a different time zone or whether you normally work, you know, from 7 in the morning to 7 at night. You know, you can trade this from anywhere. These are, you know, your office can be literally anywhere. It can be in a plane. Like my best trade I did in the last 2 months was when I took off from Canada, flying to Australia. And by the time I'd landed, I'd already paid for, you know, my accommodation and my flight. That's a really awesome trade to have. So, guys, we're closing in on the end of the time. But look, the course we've put together here is absolutely awesome. It covers everything you need to know. You get access to those 3 systems I talked about at the beginning, which is the 3 indicators. It talks about the how to use those. You have lifetime access to all 3 systems and the training of them, especially including that S&P 500 indicator, because we will no longer be offering that indicator in about a month from now. It's just too valuable. We've got to the point where we're trying to protect it. So this is one of the last opportunities to get access to that S&P signal indicator. Then we're taking it off and turning it into a signal on our website in about a month. But for now, you'll have lifetime access to it and all of how it works. You've got training on the foundations behind the education and how to use it. That's there for life. So you can set up your 1, 2, 3 process. Patterns. Obviously, I've talked a lot about patterns, so it's really important you understand those. It's really important you understand when you look at a chart, you know, when you're looking at the S&P 500, you know, why that's a head and shoulders. You need to be able to recognize that. You need to be able to recognize that that's an upward channel instead of drawing your lines differently and coming up with a different answer, right? There's a lot of people that are well trained, but aren't applying it correctly. And that's the difference. The devil is in the details, especially when it comes to pattern recognition. And it's not a skill you are born with. It is a skill that is learned. It is rule-based. It is not subjective. So in module 2, we're going to go through the how to follow the rules to identify the correct pattern. And once you have that, it's just about following the rules of how to trade it. Very, very easy, right? That's what trading should be. And this leads up to our scan. Okay, this leads up to our scan. So the smart money long scan, smart money short scan. So the long scan is how we found all of those longs, and it's what we run every week. Typically, I run this on a Sunday, and I look for all of my trades for the week on the weekend. And then I'll pre-program when to get in, when to get out, what options to buy. All of that's predetermined, usually on the Sunday, from running these scans. So the long scans included, and you have access to that for life. The short scan is how we found all of our shorts, and you'll have access to that for life as well. And again, all of these trades came from these scans, and we'll show it was about an hour lesson which comes with each scan showing you how to use it. We then run it in live markets and pick out our favorite ones, and you'll get to see what they did afterwards. In both of those situations, the stocks just did incredible. So you'll see it applied in live situations there. Last but not least, the alerts. So of course the market is incredibly exciting right now, and as you've seen, we are on the cusp of another big potential turning point for the S&P 500. So the alerts are a very key part to our service, and you'll get to be able to follow along with all of the trades we do for the next 12 months. So before I take a trade with my own money, we'll announce that. We'll send out an alert on Sunday saying, right, here are the 5 trades we're looking to get in based on the highest probability patterns, and we'll show those and we'll break it down for you in the video. this is what the pattern is. This is how we found it. We'll draw the lines so you can see it and learn from it live. And then here's what the smart money's doing. We'll go in and research who the insiders are, so you know, like this guy who's buying is the 39th richest man in North America, for example, which is one of the longs we're looking at the moment. This energy company, the insider buying this stock is the wealthiest person in all of North America. There's a few examples we're looking at right now, which are just quite impressive when you know who the insiders are. So we break all that down. The ideas are actionable with entries, targets, stop losses, and any options we're considering. So we do all the work for you, and we send it out once a week. We then have our live class every Tuesday, Thursday at 4 p.m. Pacific. This is where we then discuss why we're buying them, all of our ideas. You can ask questions about stocks you may have found, but it's basically taking the theory and putting it into practice every Tuesday, Thursday. Excuse me. And what comes with this is we give you a full guarantee, so that if you don't see your money at least doubled by the next 12 months, and that is something that in these kinds of markets, we have much higher expectations than that. But that is something we put together before the market started to do what it's doing now. So I would have no, I think we would far exceed this, but that is that's there. So you would then get the next 12 months completely free if we didn't hit that minimum benchmark. So there you go. There's a summary. So again, just breaking this down for you. Smart money indicators are included for life. Those are normally $2.97. Smart money scans are included for life. Those are normally $9.97. One-on-one, you'll actually be given your own one-on-one coach. So as you go through this training, you'll be given a personal coach that will take you through all of the modules. That is infinitely valuable. And that is only for the first 20 people, because we obviously have to limit that. You'll have your own coach to take you through this entire course. So your learning curve goes straight up. You've got a year of alerts, which is normally $17.50. That's included. And a year of access to those live Tuesday, Thursday classes, which is normally $15.88. So your package is awesome. It's looking at over $4,400 in value minimum. Right. So again, to sign up, you just go to www.acornwealthcorp.com/smart. All right. I think I'm at basically the end of my time. Please interrupt me, Jeanette, if I want me off.
Johnny, go ahead and you have a lot of questions. Why don't you go ahead and answer some questions?
Sure. See, Jeanette always is upset with me because I talk longer than I should.
That's why I put you up last, because I know your ways.
All right.
You go ahead. Take about 10 minutes worth of questions, and then we'll wrap it.
All righty then. So let's take some questions here. Does 5 actionable mean 5 trades a week? Yes, it does. Yes. So five trades a week minimum. If we find some extra ones, you'll see those will come out on the Tuesday, Thursday sessions. And usually that's because the beautiful thing about Acorn is our students have been with us for years. Like, we have one of the best retention rates in the industry. When people come to us, they stay with us. And like Micah was talking about how many people go to his annual memberships. I mean, we very rarely have people ever cancel. And so the students that join us on Tuesdays, Thursdays, they've been with us, some of them for 5, 6, 7, 8, 9, 10 years. And so we've got this whole community of acorns that are all looking for these ideas. So on those Tuesday, Thursday sessions, they'll say, "Hey, John, what do you think of this stock?" And I'll be like, "That is amazing. Let's buy that one." What was the one? There was one a student found for me last week. Check this one out. PTLA. Right, this one had insider buying. It's a beautiful momentum pattern, and we found this as a buy. I think it was April 23rd, or it was April 24th, I think, at $7. Yesterday, gapped up to $18. Right, these are the kinds of things that we get to find as a group and through these scans, which is really awesome. I mean, there's nothing wrong with 130% overnight return. Anyway, so yes, at least 5 trades a week, and that's the core smart money focus Obviously, you'll have the scanner yourself. So if you want to find more than that, you'll be able to click a button and find them. But the idea here is for us to do some of that work, a lot of that work for you, and find the 5 favorite ones that we like. You do not need any special software. So you do not need a TOS or NinjaTrader or anything. We provide the scanning, the scan, and the indicators. Everything is provided by us. Okay, so you don't need any software, as everything is run independent of you, of whatever program you're currently using. We do have some smart money indicators that we've included in this package, and those work on Thinkorswim, TradeStation, NinjaTrader, TC2000, Incredible Charts, TradingView, and Metastock. So if you have any of those programs, there are some extra bonuses for you. After the first year, what's the price? $147 per month, or if you prefer, you will be grandfathered in at the $997 per year rate. But after 12 months, that should, again, hopefully be a non-existent problem if we've done our job right. What amount is needed to start? LG, look, one of the common things that I remember, one of my first ever students at Acorn back in 2007, he had over $1 million in his account, and he had gone through, I won't mention names, but he'd spent $30,000 on education. So one of the biggest difficulties for him was letting go of all of the bad habits, because he thought, well, I've already paid all this money. I should probably use what I've learned. Problem was, is he'd spent $30,000 on the wrong education. He was doing it wrong. And he'd learned little bits and pieces of everything that he was trying to jam into this one strategy, which just wasn't working. And sometimes you just got to cut your losses and start fresh. I did, and I never looked back. So, you know, this guy, he was difficult to work with at the beginning because he wouldn't let go of his old habits. And with his $1 million, in 3 months, he'd already lost 100 grand that I watched him do following other strategies. Meanwhile, I had this other student that I was working with in Vancouver, and she only had 18,000 bucks in her account. She wasn't even a good trader. Like she only probably got it right 60% of the time. But her risk management was on point. Her stop losses were on point, and she made about 3 grand over the same period. And this became a lesson that I learned as a coach that I've talked about a lot over the years, that the person with $18,000 in their account made more money than the person with $1 million in their account because they were doing it right. So it doesn't matter with what you start with, whether it's 2,000, 3,000, or $1 million. It's about quality, about rules. That's how you make money. It's not what you start with. So as long as you have a good commission broker like Robinhood, like Micah was saying, and commissions aren't eating up your profits, even a small account's going to work very well with this strategy, because this is all about finding quality positions that have big potential. We're not getting in and out of 50 different trades just to make 5%. We're looking for those trades that can go up 50, 100, 200, 300, 400, ones that have real guts that we might end up holding for a couple of months because they just keep going. I hope that answers your question, LG. Bob, I hope I've answered your question as well. Dinka, are Asia Pacific countries really bearish, or are they turning around slowly compared to Europe and North America? I mean, look, I've been watching the Aussie market, and you know, your problem, I'll just leave the link on the screen, acornwealthcorp.com/smart. Just go there. But if you have a look at some of the overseas economies, you know, it's not much better. The ASX has not recovered, of course, anywhere near as much as the S&P 500 has, and as you can see on the ASX, we are right underneath resistance, right? Where we broke down from, this massive upward channel on the Australian Stock Exchange, we are right underneath resistance. This is not a recovery. This is not a V-shaped recovery. This is a dead cat bounce because of Fed intervention, which it's like trying to cure a drought by throwing a bucket of water over it every day. It doesn't work long term. The Aussie market's under pressure. And if you look at the global index, which is the GDAX, which is the weighted global index, the DJWO. when you look at the Dow Jones Global Index, the pattern that we see on this is very much the same. And this is a globally weighted index, which includes the US and the Asia Pacific and so forth. And if you zoom into these areas, you're going to see that same bearish turning point that we've seen in the US markets. So no, I've had more friends and family members hit me up on Facebook in the last 4 weeks about how to trade this market than ever in my life. And my words to them is, look, focus on quality. Don't buy a stock because it's cheap. Buy a stock because it's got a ton of insider buying and the perfect pattern. But in most part, we should be looking for shorting opportunities. All right. Yeah, exactly, Charles. Garbage is garbage, regardless of how much you pay for it. Right? A stock that looks cheap at $5 will be really cheap at $1. Ben, drop me an email. Yeah, look, if you have any special questions, you can drop me an email at info@acornwealthcorp.com. info@acornwealthcorp.com. And again, just on that note, by the way, this is a screenshot from one of my friends. He asked me how to trade the market. There's a guy I met in Mexico. I said, look, come to my webinar and you'll see what I'm thinking about the market. He attended this same workshop, signed up with the 997 program about 3 or 4 weeks ago. And again, he sent me a Facebook message. 2 days later, I asked him, have you made your 997 back yet? Already in 2 days he had. So this is an investment for something that you'll now have for life and pays for itself many, many times over. What was the split between stocks and options in our trades last year? About 85% stock. Personally, all of our alerts are mostly optionable. I'd probably say about 70-80% of the trade alerts we send out are optionable, but I just personally prefer the stock side because I use margin to leverage instead of the option. More of a personal preference, so I can completely automate everything and set and forget. Okay, so again, they're 997, which covers all of the modules. And again, for the first 20 people today, that will also include the one-on-one coaching. And that's from people that are previous students of mine that were awesome students, and I hired them as coaches. So you're learning from people that were in the same situation as you 7 or 8 years ago, which is pretty powerful. I want to thank everybody. I'm over my time now by a good shot, but again, I want to thank everyone for coming today, and I especially want to thank Jeanette and all the other speakers and everyone over at Westmark and TradeThirsty for putting on a fantastic event. And again, I hope you've found some real nuggets here. So I'll pass it back over to you, Jeanette, and again, hope to be working with many of you in the upcoming live sessions.